Hello and welcome to Session 15 of the Basic Tax Course. We're going to begin Session 15 with a review of the Session 13 quiz answer key. And I have up in front of you now the Session 13 quiz. And the first question that I will review, because it was a most frequently missed question, is question number 1. Which of the following is a capital asset? We describe inventory, depreciable property used in a business, and a painting owned and created by an artist. None of those are capital assets. It is only the investment use property that is a capital asset. And just as a reminder, a work of art, if created by you, is not a capital asset, but if you purchased a painting, that would be a capital asset, unless, of course, you held it as inventory for sale. So essentially, we're looking at property you purchase and use for personal purposes is a capital asset, but a property that you create through your own efforts or that is used for income production in a business is not a capital asset. Next question to review is question number 4. Jane sells property she received as a gift. The fair market value at the time of the gift was less than the donor's basis. She sells the property at a gain. Her cost basis is the fair market value of the property on the date she received it, plus or minus any adjustments to the property during the time she held it. That is a false statement. And the reason it is false is when you sell property at a gain and the fair market value at the time of the gift is less than the cost, then you will use cost as a basis for figuring gain or loss on the sale. The next question we're going to review is question number 6. Points you pay on behalf of the buyer of your home are deductible by you on Schedule A. That is false. Points you pay on behalf of the buyer of your home are not deductible by you on Schedule A, but they are deductible by the buyer of your home. So this is exactly the opposite of the truth. Number 14, your pet dog is a capital asset. That is true. Personal property owned by you that is not held for business use is a capital asset, even if it is the family pet. Number 15, if you sell property you inherited at a loss, your basis is generally the fair market value of the property on the date you received it, plus or minus any adjustment to the property during the time that you held it. This is a false statement. The reason it is false is you do not look to the date that you received property that you inherited. You look to the date that was established by the estate. Typically, that is the date of death. Sometimes it is 6 months after the date of the death, but it is never the date that you received it. It is the date of death or 6 months after the date of death, whatever date was established by the estate. So that is it for the questions that I'm going to review as most frequently missed on the Basis of Assets quiz. It was not a terribly difficult quiz in terms of the number of frequently missed questions was not really high. If you have any other questions about the quiz, of course, do refer to the answer key inside the Learning Management System. And the next topic for today's class is to review the Session 14 homework answer key. And of course, the Session 14 homework assignment was a multi-part assignment. And in the first part, Part A, we're asking you to identify which of the following assets are depreciable. And we'll just take these one at a time. Your personal car, which you do not use for business. Of course, if it's not used for business, it is not depreciable. So that would be false. Number 2, a truck you use 65% for business. Yes, that is depreciable, so that is a true statement. Number 3, your qualified home office in a home that you own. Is it depreciable? Yes, it is. That is a true statement. Number 4, a hand tool with a useful life of 6 months that you use for business. Is that depreciable? The answer is false. No, it is not. Property must have a useful life of more than a year. It cannot have been placed into and taken out of service in the same year. So 6 months of use definitely is not more than a year. It is not depreciable. Number 5, a photocopier you bought and sold in the same year. Is that depreciable? The answer is false. No, it is not. Again, same as above. Property placed into and taken out of service in the same year is not depreciable. Land, is that depreciable? Never. Land is never depreciable. False. Number 7, improvements to land used for business, are they depreciable? Well, the answer is yes. Land improvements are depreciable, but we have to be careful about land improvements. In certain situations, land improvements are depreciable. In other situations, they are not depreciable. In situations where land improvements are depreciable, they have a 15-year life. Number 8, your personal use car, which you use 30% in your business activity, is that depreciable? Yes, it is. Number 9, a Section 197 franchise startup cost totaling $25,000, is that depreciable? Technically, no. That is a false statement. The reason it's false is you do not depreciate franchise startup costs. You amortize those. And number 10, your laptop computer, which you use 85% in your business, is that depreciable? The answer is yes, it is depreciable. Homework assignment B asks you to prepare Form 4562 and a depreciation schedule for the following assets, and it provides the following information. It says, assume that all assets from both depreciation schedules are for the same taxpayer. That means there will be some interrelation between the two 4562s, but you do need to separate the assets between the two businesses, and that means there will be two 4562s and two separate depreciation schedules. Also, startup costs are to be amortized and not expensed, so we want to see you treat those correctly on the Form 4562. Claiming a full Section 179 deduction for the copier and a $1,000 Section 179 deduction for the racehorse. So we want you to treat that correctly. Assume business income of $510,000. Do not take any bonus depreciation, and assume the following information on the car: business miles 17,000, total miles 20,000, and let's take a look at the assets that we're depreciating. We have a car, computer, copier, desk, startup costs, file cabinet, racehorse to be used in business activity number 1. And then in business activity number 2, which is obviously a farming business, we have a dairy cow and a chicken coop. And we want you to depreciate those correctly for each of these situations. So let's take a look at the answer key for this assignment. So let's begin with the car. We noticed that the car was placed in service in 2008, cost of $20,000, business use 85%, and we did have prior Section 179 deduction of $20,000 and prior depreciation of $4,596. Now, in our answer key, we have shown you how we went about calculating the prior year depreciation, where those computations come from, and I'm not going to read those to you, but they're there for you if you would like to look up how we did those calculations. This is the third year that the car has been used for business, and to complete the depreciation schedule, you will need that prior year depreciation to be entered. So here is the depreciation schedule for the first part of our homework assignment. Part 1 involves claiming depreciation or figuring depreciation for the car that was placed in service in 2008. And it shows you prior Section 179 deduction and prior depreciation claimed. For 2010, we're going back to the original cost basis of the car and entering that on the tax return, multiplying it by the business use percentage, entering the previous amount of Section 179 deduction that has been allowed, and getting a depreciable basis of $15,000. The life on the car is 5 years. We are into the third year on that car. So in the third year of 5-year property under Maker's depreciation rules, you would claim 19.2% depreciation. However, this car is limited because it is a car. You're limited by the depreciation limits on automobiles, and in the third year, the maximum amount of depreciation you are allowed to claim is $2,850. And of course, you take $2,850, you multiply that by 85%, and you're going to get current year allowable depreciation on that vehicle of $2,423. We add that to the prior depreciation claimed, shown on the depreciation schedule, which is $4,596 plus $2,000. We add in the $2,423, and that gives us accumulated depreciation of $9,019. Next comes the computer. The computer was placed in service in 2010. It has a cost of $2,000. The business use percentage is 50%. That leaves us with a depreciable basis of $1,000. And of course, it is 5-year property, but because it is not used more than 50% in a business, we have to use straight line depreciation under the alternative depreciation system and apply a half-year convention. Once we do that, we end up with a rate of 10% for the first year and a depreciation deduction of $100. Of course, the computer has to be listed in Part 5 of Form 4562. So next up we have the desk, and the desk was placed in service in an earlier year, 2009. And in 2009 we reported a cost of $500, business use percentage of 75%, prior Section 179 deduction has been claimed of $150, and prior depreciation claimed is $27. So how do we treat this in 2010? Well, for 2010, we still show that original cost. We still show 75% business use. We indicate that prior Section 179 of $150 has been claimed. And then we look at the basis for depreciation. Well, the basis for depreciation is going to be $450 multiplied by 75% minus $150. And when we do that, we get $188. The life of the desk is 7 years. We then apply 200% declining balance, and obviously we're into the second year. So ultimately, we end up with 24.49% of $188 being our allowable deduction per the maker's table. If you do it longhand, you'll arrive at the same answer. That leaves current year depreciation at $46, and that $46 will be entered on line 17 of Form 4562. Next up is the copier. It has a cost of $5,000. We're claiming a $5,000 Section 179 deduction on it, and we are claiming 100% business use on it. So we're going to enter that in Part 1 of Form 4562. Then we have startup costs. Startup costs were $3,000. We're not expensing them. Those will get reported in Part 6 of Form 4562. The file cabinet was placed in service in 2010. We're claiming regular maker's depreciation on the file cabinet. It will appear on line 19 as 7-year property. The racehorse at a cost of $3,000 is 3-year property. We are claiming a $1,000 Section 179 deduction on it, so it will appear in Part 1 and be entered also on line 19 of Form 4562. Let's look at the depreciation deduction on the file cabinet. The file cabinet has a cost of $120. It is 100% business use. A depreciable basis of $120, 7-year depreciation. The first year depreciation deduction for that unit is 14.29% or $17 of depreciation. The racehorse has a cost of $3,000. It is 3-year property, but we are claiming Section 179 deduction of $1,000. That leaves us a depreciable basis of $2,000. We divide that by 3 and we get $667 of current depreciation on the car, plus the $1,000 Section 179 deduction gives us total current depreciation that we will be claiming on Form 4562, but it's going to be split up between 2 lines. The business startup costs are, of course, again reported in Part 6. They're $3,000. They're amortized over 15 years, beginning with the month that they're placed in service. And so the placed in service date is June. And so we're going to claim amortization for 7 months, including the month of June. So we'll go $3,000 divided by 15, divided by 12, multiplied by 7, and that will give us $117. So let's go take a look at the 4562. We begin the 4562 by filling out Part 5 on page 2, and there we enter the car first. We show that 85% business use. The date placed in service is 2008, $20,000 cost. We took a $2,000 Section 179 deduction. That reduced the cost basis. We basically take $20,000, multiply 85%. We subtract out $2,000, and we get $15,000. It doesn't really matter what we enter on these lines. We're still affected by the limit on automobiles, which is 85% of the maximum allowed, $2,850. We enter 2423 on the line. The computer, as I said, is used 50% or less in a qualified business, and so we enter it on line 27. We're going to apply ADS and a half-year convention. So 50% of 2,000 is 1,000. We divide that by 5. Apply the half-year convention, which gives us a half-year of depreciation for that first year, and we have $100. Total depreciation claimed on page 2 on line 28 is $2,523, and that will carry to page 1 and get entered on line 21. Next, we have the vehicle where we need to enter the total number of business miles driven. We gave you that information in the wording of the problem right here. Business miles 17,000, total miles 20, commute miles 0. We carry that information and enter it. Business miles 17, other personal miles 3,000, commute miles were entered at 0. Total business miles is obviously 3 plus 17, and that gives us 20,000. Was the vehicle available for personal use? Was the vehicle used by a business owner? Is it available for personal use? We answered yes to all of those questions, and it is up to you to make those decisions by interviewing your client. Next, at the bottom of Form 4562 on Part 6, this is where we enter the business startup costs. We enter a description of the startup, and it was business startup cost. We enter the date placed in service, or the date amortization begins, which was June 15, 2010. The amortizable amount is $3,000. The code section is Section 195. The amortization period, 15 years. So 3,000 divided by 15 divided by 12 multiplied by 7 is $117. That will carry to the Schedule C and be entered as an expense on Schedule C. Now we're on page 1 of the Form 4562. You can see we entered Schedule C1 to identify the business activity. We enter the automatic limit that applies to most businesses, which is the maximum deduction allowed for any business, $500,000. We then enter the total cost of Section 179 property placed in service during the year. So let's take a look at where we got our computations for Part 1. A Section 179 deduction is being claimed for the copier and the racehorse, and these are the entries that need to be made in Part 1. You include the cost of all assets placed in service during the year for all business activities of the taxpayer that could be eligible for the Section 179 deduction or are listed property on line 2. You include 50% of the cost of the computer for business usage. Since the computer is listed property, not used more than 50% in a business, it is not eligible for the Section 179 deduction. So we computed as follows. Assets placed in service during the year total $16,120. And here I have a table to show you how we computed that. Essentially, we look at 100% of the cost of each of the assets, and then we have to multiply that out by the business use percentage. The only asset that was not used 100% is the computer, and so the total cost of all of these assets was $17,120. We apply that 50% business use to the computer, and of course that cost drops down to $16,120, and that is the amount we enter in Part 1 of Form 4562. And there you have that entry, $16,120. Next, we list the property that is being expensed under Section 179. That includes the copier and the racehorse. In the case of the copier, you were told in the instructions for the problem to expense the full cost of the copier, but in the case of the racehorse, we said just claim $1,000. So we've done that. We enter the cost of the property, the amount that we're electing to expense, total those amounts up, and we have $6,000. Then on line 17, we enter depreciation for assets placed in service before 2010. Let's go back to the depreciation schedule just for a refresher of where that $46 number comes from. And current year depreciation for an asset placed in service in an earlier year. The asset that we're looking at here is the desk. And remember, we entered current depreciation on that schedule for that desk. And because the desk is placed in service in an earlier year, the deduction is entered on line 17 of Form 4562. Then we look on line 19 to claim depreciation for assets that are not listed property that were placed in service during the current year. We have the racehorse and we have the file cabinet. The racehorse is 3-year property. It had an acquisition cost of $3,000, but we reduced that cost by $1,000 in Part 1. So we begin Part 2 by entering the remaining cost basis, $2,000. The recovery period is 3 years. We apply the half-year convention. The method is 200% declining balance, and there's that $667 deduction that I already showed you on the depreciation schedule. 7-year property on the file cabinet, 200% declining balance, and we get a $17 depreciation entry for the year. Now it's time to total up all of our deductions. We have $6,000 of Section 179 expense, $667 for 3-year property, $17 for 7-year property, $46 for prior year property. Listed property from Part 5 is $2,523, and that leaves us total depreciation for this Schedule C business activity of $9,253. Let's take a look now at the farm activity. The farm activity, we have the dairy cow and the chicken coop, both 100% business use, both assets placed in service during the current year, 2010. Cost on the cow, $2,000. Depreciable basis, $2,000. The cow is 5-year property, but because this is a farming activity, we must apply 150% declining balance, and that gives us a first-year depreciation rate of 15% and a current year deduction of $300. The chicken coop is, of course, 10-year property. It also has a 150% declining balance being applied, so we take the $5,000 cost. We divide that by 10 years. We then apply 150% declining balance after applying the half-year convention. So we essentially go 5,000 divided by 10, divided by 2, multiplied by 1.5, and that gives us $375. Here is the depreciation schedule. We've entered Schedule F1 because this is the farming activity. And we've listed the 5-year property as the cow, the 10-year property as the chicken coop, and we of course enter 2,000, 5-year recovery period, half-year convention, 150% declining balance, and a first-year deduction of $300. The chicken coop, $5,000 cost, 10-year recovery period, half-year convention, 150% declining balance, and a first-year deduction of $375. The total depreciation being claimed on this business activity is $675. There is no amortization deduction being claimed for the farming activity. There is no listed property for the farming activity, and so Part 2, or Page 2, rather, of Form 4562 is not completed for the Schedule F. So that concludes the review of the homework answer key. At this point, please push pause on video playback, complete the Session 14 quiz assignment inside the Learning Management System. When you are finished with the Session 14 quiz, please resume video playback and we will begin the Session 15 lecture. Okay, at this point you should have finished taking your Session 14 quiz. But now time to get on with the lecture topic for the day, which is sales and other dispositions of property. We're essentially going to be focusing on two different tax forms today. One of those forms is Schedule D. And Schedule D is the IRS form which is used to report capital gains and losses. And remember, in our earlier sessions we've been discussing the definition of a capital asset and a non-capital asset. Well, the reason we want to know what a capital asset is because when we sell a capital asset, well, we would be reporting capital gain income. And capital gain income or capital loss is reported on Schedule D. Schedule D is a two-page form, and it is a multi-part form. Part 1 of the form is used to report short-term capital gains and losses. And we're going to be looking at what defines short-term and long-term today, because if an asset is sold short-term, it is reported in Part 1. And if an asset is sold long-term, it is reported in Part 2. Let's move over to page 2 of this form. And page 2 of the form provides a summary, and on page 2 you are calculating or making entries for specific types of specialized items, such as items that fall under the 28% rate gain and unrecaptured Section 1250 gain. So we'll be learning what that means in today's class as well. The next form, or the other form that we're going to be looking at today, is Form 4797. And remember, in our class on depreciation, we talked about Form 4562. Well, 4797 is sort of the opposite of 4562. When you have an asset that you place in service in your business, you need to depreciate that asset. And the first year that you depreciate that asset, you need to report that asset being placed into service and depreciation being started on that asset utilizing Form 4562. Well, there comes a day when, well, the asset is no longer being used in the business, either because it was lost, broken, sold, or even stolen, or destroyed in a casualty loss of some kind. And when an asset is disposed of, and that asset is a depreciable asset or even a non-depreciable asset that was used in a trade or business, then that asset disposition is reported on Form 4797, Sale of Business Property. 4797 is divided into 4 parts. In Part 1, we report sale or exchanges of property used in a trade or business and involuntary conversions from other than casualty or theft, most property held more than a year. And in Part 2, we report ordinary gains and losses, typically for assets that were held for a year or less, but we'll learn more about that. In Part 3, we report gain from disposition of property under Sections 1245, 1250, 1252, 1254, and 1255. Well, what does all that mean? Well, we're going to learn about that in today's class. And way down at the bottom of the form, right at the bottom, we have Part 4, and it says recapture amounts under Section 179 and 280FB2 when business use drops to 50% or less. And we're going to learn about that too. So let's move on with the lecture part of today's class. By the end of today's session, you will have learned the difference between a sale and a trade, special rules for sales between related parties, the difference between a capital and non-capital asset, how to determine your holding period, and whether you have a taxable sale or trade. Firstly, sales and trades. In order to calculate whether you have a taxable sale, you must first determine the nature of the property you are selling and whether you have a gain or loss. In general, you do not need to report the sale of personal property you sell at a loss. This is because the loss is not deductible to you. However, if you sell your personal property at a profit, or if you sold investment property, then you do need to report your sale. A sale is generally a transfer of property for money or a promise to pay money in the form of a mortgage or note. A trade is a transfer of property for other property. If you sell property for money and then immediately use that money to purchase replacement property, you do not have a trade. Capital gains and losses. Generally, you will have a capital gain or loss if you sell or exchange a capital asset. You may also have a capital gain if you sell a Section 1231 business asset at a gain. Section 1231 business property is property used in a trade or business for more than 1 year that is not inventory. Character of gain or loss. You need to classify your gains and losses as either ordinary or capital. Ordinary gains result from the sale of non-capital assets, such as property held mainly for sale to customers, also known as inventory, depreciable property used in your trade or business, real property used in your trade or business, a copyright, a literary, musical, or artistic composition, a letter or memorandum, or similar property, such as drafts of speeches, recordings, transcripts, manuscripts, drawings, or photographs, accounts or notes receivable, supplies of a type you regularly use or consume in the ordinary course of your trade or business. Capital gains result from the sale of your personal assets or investments, such as stocks or bonds held in your personal account, a house owned and used by you and your family, household furnishings, a car used for pleasure or commuting, coin or stamp collections, gems and jewelry, gold, silver, or any other metal, timber grown on your home property or investment property, even if you make casual sales of the timber. Holding period. Holding period is very important because remember I showed you Schedule D, Part 1, where you report short-term gains, and Part 2, where you report long-term gains or losses. Holding period is how you determine which part of that form to use. If you sold or traded investment property, you must determine your holding period for the property. Your holding period determines whether any capital gain or loss was short-term or long-term capital gain or loss. Short-term and long-term defined. Short-term is investment property held 1 year or less. Long-term is investment property held more than 1 year. To determine how long you held investment property, begin counting on the date after the day you acquired the property. The day you dispose of the property is a part of your holding period. And here's an illustration. You bought an asset on June 18, 2009. You start counting on June 19, 2009. If you sold the asset on June 18, 2010, your holding period is not longer than 1 year. If you sold the asset on June 19, 2010, your holding period is more than 1 year. Securities traded on established market. If you bought or sold through the stock market, your holding period begins on the day after the trade date you bought the securities and ends on the trade date that you sold them. Please note, though, do not confuse the trade date with the settlement date, which is the date by which the stock must be delivered and payment must be made. You should report any gain or loss in 2010 for any sale with a trade date ending in 2010, even if the settlement date for the sale was the beginning of 2011. Stock dividends. If you receive taxable dividends in the form of stock, essentially a dividend reinvestment, your holding period begins on the date of the dividend distribution. If you received a non-taxable dividend in the form of a stock split or a spin-off, your holding period is the same as for the original stock. Non-taxable trades. If you received property in a trade, your holding period for the new property begins on the day after you originally acquired the old property you traded away. Property received as a gift. Your holding period for property you received as a gift depends on your basis. If your basis is the giver's basis, your holding period starts on the same day as the giver's holding period. But if your basis is the fair market value, then your holding period starts on the day after the date of the gift. Inherited property. If you inherited property, your holding period is always long-term. How to figure gain or loss on the sale of property. To calculate your gain or profit or loss on the sale or trade of property, you must first calculate the following: your adjusted basis in the property and the amount you realized from the sale. Adjusted basis in property sold. What is your adjusted basis in the property you sold? Well, your adjusted basis in property you sold is your original cost basis in the property plus and minus certain adjustment items. What is the amount you realized from the sale? Well, the amount you realized from the sale of property is everything you received for the property, including cash, notes or mortgages payable to you, mortgages or other debts owed by you and assumed by the buyer, and other property or services you receive in exchange for your property. Seller financing. If you finance the sale of your property, the amount you realize is the total of all of the payments you received over the lifetime of the loan minus interest. This is because all loans are treated as having two components, interest and principal. If your loan does not state the rate of interest that applies, the IRS will apply a minimum rate of interest. And here's an illustration. You sell your rental home under a contract sale on January 1, 2009. The sales price is $150,000. The buyer pays you $10,000 down and agrees to pay you the remaining $140,000 within the next 18 months. On January 1, 2010, the buyer pays you $140,000. There is no stated interest amount for this transaction. Even though the interest was not stated, we must construe that interest was in fact paid. You must allocate a portion of the sales proceeds to interest at a fair market rate. If the fair market rate for this transaction is 8% per year, then you must subtract unstated interest from the sales price. In this example, unstated interest would be $140,000 times 8%, which is $11,200. Therefore, the true amount realized from the sale is the $10,000 down payment plus the $128,800 that is left after subtracting interest from the remaining amount of the sales proceeds. That gives us the amount realized on the sale as actually being $138,800. And the amount of interest that you will need to report on your 2010 return is $11,200. So what's going on here, and why are we forced to treat part of this installment sale as interest? Well, the answer is interest does not get capital gain treatment, and the IRS wants to ensure that you don't artificially inflate the sales price of a property to disguise interest as capital gain. Interest is taxed as interest, capital gain is taxed as capital gain, and you can't finagle things in such a way as to get better tax treatment. Another reason that I believe this is going on is because the IRS does look at gift rules, and when you have a parent or a relative or even a friend that wants to give a very large gift, it is possible that gift rules will come into play, and that means there could be gift tax. And the IRS doesn't want to see wealthy individuals giving interest-free loans to their children, for example, to bypass gift laws. So again, the IRS wants to see interest being construed, it wants to see interest being applied, and it will apply interest or construe interest as in fact having been paid if you do not treat interest or allocate for a fair portion of interest in an installment sale or any other kind of loan. Treatment of capital losses. If your capital losses are more than your capital gains, you can deduct your allowable losses against your taxable income. The yearly limit on the amount of capital loss you can deduct is $3,000, or half that amount if you are married filing separate. Capital loss carryover. If your net losses are greater than $3,000, you must generally carry your losses forward to the next year. Short-term and long-term losses. When you carry over a loss, it retains its original character as either long-term or short-term. A short-term loss you carry over to the next tax year is added to short-term losses occurring in that year. A long-term loss carryover is added to long-term losses occurring in the next year. If you have both short-term and long-term losses, your short-term losses are used first against your allowable capital loss deduction. If after using your short-term losses you have not reached the limit on the capital loss deduction, you then use your long-term losses until you reach the limit. And here is an illustration. In 2008, you had short-term losses of $6,000 and long-term losses of $8,000 on stock you sold. You claim your short-term capital loss first, so your allowable loss on your 2008 return is $3,000 short-term. Your carryover loss to 2009 is $3,000 short-term and $8,000 long-term. Then in 2009, you report short-term gains of $2,000 and long-term gains of $3,000. You subtract your short-term gain from your short-term loss carryover. $3,000 of carryover minus $2,000 of gain leaves us with a net loss short-term of $1,000. Then you subtract your long-term gain from your long-term loss carryover. $8,000 of carryover minus $3,000 of gain gives us a net long-term loss of $5,000. Your allowable loss on your 2009 return is $1,000 short-term and $2,000 long-term, and your carry-forward loss to 2010 is $3,000 long-term. Then in 2010, you report short-term gains of $4,000 and long-term gains of $10,000. You report your short-term gains in full at $4,000. Subtract your long-term loss carry-forward from your long-term gain. $10,000 of gain minus $3,000 of long-term carry-forward is net gain long-term of $7,000. So the total gains that you will report on your tax return for 2010 are $4,000 short-term plus $7,000 long-term. Now I've created a table to help summarize these amounts, and we can see that we've got short-term gain or loss on this side, and we have long-term gain or loss on this side. In 2008, we have a short-term loss of $6,000, and $3,000 of loss short-term is claimed on the 2008 return, leaving $3,000 to carry forward to the next year. That same year, we have an $8,000 long-term loss, none of which is claimed, so the full loss of $8,000 is carried forward. Then in 2009, we have a gain of $2,000, but we subtract out that $3,000 carry forward, leaving us with an allowable loss to claim on that year's return of $1,000. We also have a $3,000 gain in 2009 that is long-term, and we subtract that from our long-term carry forward of $8,000. That leaves us with net long-term losses of $5,000, but we're going to claim $2,000 of that loss on the 2009 return as a long-term loss. That leaves us with $3,000 to carry forward as a loss carry forward to 2010. Then in 2010, we have a $4,000 long-term gain. We have no loss carry forward to offset it, so all $4,000 is reported as short-term gain. In 2010, we also have a $10,000 capital gain. We're going to offset that with the $3,000 long-term carry-forward loss. That leaves us with an allowable or remaining gain for 2010 of $7,000. So on our 2010 return, we're going to report long-term gains of $7,000 and short-term gains of $4,000. So how do I figure my capital loss carry forward? Well, I just showed you the way that I think when I calculate long-term loss carry-forwards and short-term loss carry-forwards. I kind of methodically go through each year figuring what happened. The IRS does have a worksheet that you can use to figure your capital loss carryover, and it is shown below. You can find this worksheet in the instructions for Schedule D on page D7. And the first password for today's lecture is the password that you will use to open the Session 13 quiz answer key. The password is Falcon, F-A-L-C-O-N. Now, what happens to any remaining long-term or short-term capital loss carry-forwards when a taxpayer dies? Well, capital losses cannot be carried over after a taxpayer's death. They can only be deducted on the final return, and the yearly limit still applies. Any excess may not be deducted. Treatment of capital gains. The 28%, 33%, and 35% income tax rates for individuals do not apply to a net capital gain. In most cases, the 10%, 15%, and 25% rates do not apply either. Instead, your net capital gains is taxed at the lower capital gain rates. Net capital gain is the gain for the year that is more than the net short-term capital loss for the year. Net capital gains are subject to lower capital gains rates of tax. And here they are. For 2010, there are several capital gain rates to apply depending on the date of the sale and the tax bracket of the taxpayer. Reduced 2010 capital gain rates were set to increase in 2011, but the reduced rates have now been extended through 2012 under the Reed-McConnell Tax Relief and Unemployment Insurance Reauthorization and Job Creation Act of 2010. So for 2010, 11, and 12, these are the capital gain rates that apply. If your net capital gain is from collectibles, then your maximum capital gain rate is 28%. If you realize a gain on the sale of qualified small business stock equal to the Section 1202 exclusion, then the capital gain rate is 28%. If you have unrecaptured Section 1250 gain, then the maximum rate is 25%. Other gain and your regular tax rate that would apply is 25% or higher, then the maximum rate is 15%, and any other capital gain and your regular tax rate that apply is lower than 25%, then the tax rate for capital gain income is 0%. So essentially what this chart is telling you is that in certain situations, the maximum capital gain rate you will pay is 28%, and that happens when you sell collectibles. There's also a situation where you might have a maximum capital gain rate of 28%, and that applies on the sale of Section 1202 stock. And I'll explain a little bit about that just with this paragraph down here. To help stimulate investment in small businesses, there was a 1993 tax law introduced under Code Section 1202, which says that you can exclude from taxable income up to 50% of the gain you realize on the sale of qualified small business stock that is acquired after August 10, 1993. The non-excluded portion of the capital gain on sale is subject to a 28% rate of tax, which essentially results in an effective rate of 14% because you're paying 28% tax, but only on 50% of the profit or gain on the entire sale. Now, the exclusion amount can be up to 7% of the gain for stock that was acquired after February 17, 2009, and up to 100% for stock acquired after September 27, 2010, and before January 1, 2012. The exclusion can be up to 60% for certain empowerment zone business stock. So this is a very specialized type of stock. It has to do with investments in small businesses. There's lots of rules about who can qualify for it and the type of business stock that does qualify. But if you have sold that kind of stock, it's a good deal when you sell it. Unrecaptured Section 1250 gain, what's that? We're going to cover that in today's class. Other gains, well, that's pretty much normal capital gains. You sold something at a profit, you held it long term, and if you did, you're typically going to pay a maximum rate of 15%. But if you're in lower tax brackets, then you will pay no tax at all to the federal government. The next topic we're going to discuss just briefly is qualified dividends. If you received qualified dividends, your dividends qualify to be taxed at the 0% and 15% tax rates, the capital gains rates, instead of ordinary income rates. Qualified dividends holding period. To qualify for the reduced tax rates, a dividend must be received on the stock held for more than 60 days in the 121-day period beginning 60 days before the ex-dividend date. Report qualified dividends on Form 1040, Line 9A and Line 9B. When using Schedule D or the Qualified Dividends and Capital Gain Rate Tax Worksheet, whichever applies to figure the tax. Exception to the 60-day holding period. If you hold preferred stock, you must have held the preferred stock for more than 90 days in the 181-day period beginning 90 days before the ex-dividend date. Qualified dividends are not included in investment income. Do you remember way back early on in the course when we talked about investment interest expense and that you could claim a deduction for investment interest expense if you had investment income? Well, qualified dividends are not included in investment income. If you paid margin interest or other investment interest expense during the year, your investment interest deduction is limited to your investment income. In general, qualified dividends are excluded from investment income. However, you may elect to treat qualified dividends as investment income on Form 4952, Line 4G. So essentially, I just finished telling you that qualified dividends do not qualify as investment income when you are claiming an investment interest expense. Well, except there is a way to be able to do it anyway, but in order to claim an interest expense deduction against your qualified dividend income, you will need to make an election to treat your qualified dividends as if they are investment income, and you do that on Form 4952, Line 4G. Next, we're going to talk about the sale of business property. When you sell or dispose of business property, your taxable gain or loss is usually a Section 1231 gain or loss. The treatment as ordinary or capital is determined under rules for Section 1231 transactions. When you dispose of depreciable property, Section 1245 property or Section 1250 property at a gain, you may have to recognize all or part of the gain as ordinary income under the depreciation recapture rules. Any remaining gain is a Section 1231 gain. So what then is Section 1231 property? Well, property that is held and used in a business for more than a year is generally considered Section 1231 property. The sale of a Section 1231 business asset is generally considered to be the sale of a capital asset, and the net gain or loss from the sale is treated as a long-term capital gain or loss. The following assets are Section 1231 assets. Section 1245 property, which includes any property that is or has been subject to an allowance for depreciation or amortization, and Section 1250 property, which is real property or real estate. Section 1231 gains or losses are the taxable gains and losses from Section 1231 transactions. How you treat the sale depends on whether you have a gain or a loss. A net Section 1231 loss is an ordinary loss reported on Form 1040, Line 14. So I have a cutout here from Form 1040, and if you have a Section 1231 loss, you report that loss on Line 14 as an ordinary loss. This is very significant because if you try to claim a loss on Line 13, your loss cannot be more than $3,000 per year. So Line 13 can never have a negative number that is more than $3,000. But Line 14 has no such restriction. So if you sell a business asset at a loss, you are able to report that loss as an ordinary loss on Line 14. So a net Section 1231 gain is ordinary income up to the amount of prior year unrecaptured losses and is reported on Line 14. The rest, if any, is a long-term capital gain reported on Form 1040, Line 13. So let's think about this a little. If you sell a business asset at a loss, the loss is deducted on Line 14. If you sell a business asset at a profit and you previously claimed depreciation on that asset, then you need to figure out how much of your profit is a result of a recapture of depreciation. And to the extent you have profit from the recapture of depreciation, that profit is reported on Line 14. But if you realize a profit on the sale of your asset because the asset increased in value, in other words, you sold it for more than what you paid for it, well, the difference between what you paid for it and what you sold it for is capital gain. And capital gains get reported on Line 13. And capital gains reported on Line 13 get capital gain treatment, those reduced capital gain rates of 0%, 15%, 25%, or 28%, depending on the type of gain you're reporting. Section 1245 property. Section 1245 property includes any property that is or has been subject to an allowance for depreciation or amortization, and which is one of the following types of property: personal property, either tangible or intangible, and certain other tangible property except buildings and their structural components as described in IRS Publication 544. When you sell Section 1245 property, any gain resulting from recapture of depreciation is treated as ordinary income. Depreciation and amortization that must be recaptured as ordinary income includes, but is not limited to, the following: ordinary depreciation deductions as well as any special depreciation allowance and the Section 179 deduction. amortization, and other deductions as described in IRS Publication 544, and any basis reduction for the investment credit, qualified electric vehicle credit, and the alternative fuel vehicle credit, and any other credits claimed against the purchase price of the asset, minus any basis increase for credit recapture. And here is another cutout again from Form 1040. We're looking at these same two lines, line 13 and line 14. Gain from the sale of a Section 1245 property asset is reported on line 13 as capital gain, and recaptured depreciation on the sale of Section 1245 property is reported on line 14 as ordinary income. Section 1250 property, that's real estate, remember. Section 1250 property includes all real property subject to an allowance for depreciation that is not and never has been Section 1245 property. Most leasehold of land and buildings are Section 1250 property. The recovery tax rate for depreciation on Section 1250 property is 25%. That's the maximum rate of tax you would have to pay if you recapture or recover depreciation on the sale of Section 1250 property. This 25% or maximum rate of 25% applies when your taxable income less capital gains is more than $34,000 if single or married filing separately, $68,000 if you are married filing jointly or a qualifying widow, or $45,550 if you are head of household. If you are below these thresholds, then your recovered depreciation is taxed as ordinary income. So here we have the cutout again from Form 1040, and whenever you sell Section 1250 property, whether your profit comes from capital gains or from unrecaptured depreciation recovery, both types of income are reported on line 13. So gain from the sale of Section 1250 property is reported on line 13 as capital gain. So let's suppose you sell a commercial building and you purchased that commercial building for $100,000 and you sold it for $200,000. Well, you have $100,000 of profit and it is reported as capital gain income on line 13. But let's suppose during the time you owned that commercial building, you also claimed $25,000 of depreciation. Well, when you sell the building, your adjusted basis in the building is the $100,000 purchase price minus $25,000 of depreciation. That leaves you with an adjusted basis of $75,000. So if you sell the building for $200,000, your profit is actually $125,000. $100,000 of that gain is capital gain, and $25,000 of that gain comes from unrecaptured Section 1250 gain, or the recovery of previously claimed depreciation. Well, if you were selling 1245 property, that depreciation would be recaptured and reported on line 14. But if you sell real estate, then that unrecaptured depreciation is reported as capital gain, but unrecaptured capital gain on line 13. And recovered depreciation or unrecaptured gain reported on line 13 has a maximum rate of 25%. Well, what does that mean? Well, it means if you are in a 28% or higher tax bracket, the most amount of tax you will have to pay on unrecaptured gain on the sale of real estate is 25%. If you are in the 25% or lower brackets, you will see no difference because, in effect, the unrecaptured gain is taxed at your highest rate, whatever that is. But when you move into the higher tax brackets, 28% and above, then you benefit from a reduced rate of tax on the sale of that property. Non-taxable trades. In general, the only kind of non-taxable trade is a Section 1031 like-kind exchange. To be non-taxable, a trade must meet all 6 of the following tests. Number 1, the property must be business or investment property. Property you hold for use in your business or investment includes things like office equipment, rental property, and land. Personal property such as your car or home does not qualify for Section 1031 treatment. Number 2, the property cannot be inventory or other items held primarily for sale. Merchandise you hold for sale is not eligible for special treatment under Section 1031. Number 3, the property cannot be stocks or bonds. Separate special rules apply to the sale and trade of stocks and bonds. Number 4, There must be a trade of like property. There must be an exchange of like property as defined by the regulations, and the following properties are considered to be like kind. Real estate for real estate, that is the exchange of city property for farm property or improved property for unimproved property. Any of those are considered to be like kind in a like kind exchange. However, real estate within the United States traded for real estate in a foreign country is not considered to be a like kind exchange. Depreciable, tangible property can be either like kind or like class. This means the property need only be in the same general asset class to qualify for like-kind exchange treatment. Examples of like-kind property in the same class include office furniture, fixtures, and equipment. A desk traded for a chair, for example, would qualify because they belong to the same class. Information systems such as computers and peripherals are also considered to be like-kind assets. Calculators and photocopiers are considered to be like kind, and breeding sheep and breeding goats are considered to be like kind. Automobiles and taxis are in the same class and are also considered like kind. But examples of not like kind property include a light general truck over 13,000 pounds is not in the same class as a heavy truck over 13,000 pounds. A breeding horse over 12 years old is not in the same class as a breeding horse under age 12. Assets used to produce sugar products are not in the same class as assets used to produce grain products. You should refer to IRS Publication 946, which is the depreciation publication, and look at Appendix B again for a detailed listing of all of the different class types. And of course, we spent quite a bit of time looking at Appendix B in Session 14 of this course. Number 5, the property to be received must be identified within 45 days after the date you transfer the property you gave up in the trade. Number 6, the property to be received must be received by the earlier of 180 days after the date on which you gave up your property, or the due date, including extensions for your tax return for the year in which the transfer of property occurs. Real estate for real estate exchanges. Now, most people think of like-kind exchanges within the context of a real estate for real estate trade. In this context, a rental property owner will want to sell one property and then use the proceeds from the sale to buy another property. Since the owner is unlikely to find another property owner willing to trade properties, the use of intermediaries is a common solution to this problem. Intermediaries allow a person wishing to make a trade to select the new property and then make the exchange through the intermediary. The intermediary charges a fee for its services, but the person making the exchange saves much more in taxes. So essentially what happens is, in a like-kind exchange, you will in effect sell your property to that intermediary, and the intermediary will sell property to you that you want to buy. And so the intermediary acts as a middleman between you and the seller of property that you're interested in buying, and you and another buyer of property that you are selling. Car trade-ins are a common form of like-kind exchange also. Not as well known, but perhaps even more common than real estate like-kind exchanges, is the exchange of one business-use automobile for another business-use automobile, or the trade-in of an old car for a new car at the dealership. If the old vehicle was used for business purposes, you will need to file Form 8824 for like-kind exchanges. And here's an illustration. The following chart illustrates how to calculate the basis of your new car when you trade in an old car. The old car has an adjusted basis of $15,000. In addition to trading in your old car, you pay $10,000 of cash for the new car. So you originally paid $25,000 for the old car, but you've claimed $10,000 of depreciation. That means your adjusted basis of the old car is $15,000. You come along and you buy a new car. The cost of the new car is $30,000, and you trade in the old car that has a cost basis to you, or an adjusted basis to you, of $15,000. And in addition to trading in the old car, you give the dealership another $10,000 cash or boot it is called. And that means your basis in the new car is your adjusted basis in the old car plus your boot. That gives you a basis of $25,000. And the purchase of price of the car actually is not relevant to calculating your cost basis. So the basis of your new car is the adjusted basis of your old car, plus or minus boot given or received. In this example, the adjusted basis in your new car is $15,000 plus $10,000, or $25,000. Your holding period for the new car begins on the date following the date you originally acquired the old car. Transfers to spouse. Generally, no gain or loss is recognized in a transfer of property to your spouse. If you receive the property from your spouse, your basis and holding period is the same as your spouse's basis and holding period. Related party transactions. If a gain is recognized on the sale or exchange of property to a related person, the gain may be ordinary income even if the property is a capital asset. A loss on the sale or exchange of property between related persons is not deductible. If you are selling property to a related party, you should refer to Publication 544 for more information. Reporting gains and losses. How you report a gain or loss depends on the nature of the property you sold and the manner in which you sold it. Personal use property. Report the sale of personal use property on Form 1040, Schedule D. You do not normally need to report the sale of personal property you sold at a loss because the loss is not deductible. However, if you received Form 1099-S, which is usually given in relation to the sale of land, your home, or a condominium unit, you will need to report the sale on Schedule D. Your allowable loss will be zero. So essentially, Schedule D would be filed for informational purposes only. If you sold your personal use property for a profit, the gain may be taxable and should be reported on Schedule D. Generally, if you owned and occupied your home for 2 of the previous 5 years and your gain is $250,000 or less, or $500,000 on a joint return, you do not need to report the sale of your home on your tax return. However, if you receive Form 1099-S, you should report the sale of your home on Schedule D and follow these procedures. Complete the Schedule D Sale of Home worksheets. Report the gross proceeds shown in Box 2 of Form 1099-S in Part 2 of Schedule D. The description for the sale should be main home. On the next line of Part 2 in Schedule D, claim the amount of the sale that is excluded from taxation and write Section 121 exclusion in Column A. Then enter the amount of the exclusion in Column F as a negative number. And here is an illustration of Form 1099-S. This illustration is very similar to the actual 1099-S's you would see a client bring in. Most companies issuing 1099-S's do follow this particular format. Box 1 is the date of closing. This is the date that the sale closed. Box 2 is gross proceeds, and generally this is the selling price of the property before any adjustments. Box 3 is the address or legal description of the property that was sold. Box 4, transfer received or will receive property or services as part of the consideration. Consideration is what you will receive in exchange for the property. Usually that's money. But if the consideration is not in form of money, this box describes the nature of the consideration you will receive. And Box 5, buyer's part of real estate tax. You can only claim a deduction for taxes assessed against you and paid by you. An amount in this box shows the amount of credit you received for taxes you paid. You must reduce your deductible taxes by the amount shown in this box. So how do you go about reporting the sale of a home on Schedule D? Here is an illustration. Peter and Betty Pan sold their home for $742,000. They had no selling expenses, and the gain on the sale is $660,000. The Pans are married and filed a joint return and meet the ownership and use tests. They qualify to exclude $500,000 of gain. The remaining gain of $160,000, that is the $660,000 profit minus the exclusion of $500,000, is reported on Schedule D, Form 1040. Page 1 of the PAN Schedule D is completed as follows. We report in Part 2 of Schedule D the main home sale, the date that it was originally acquired, the date that it was sold, the sales price, the cost of the home, and the gain on the sale, which is essentially column D minus column E equals the gain on the sale. But they don't have to pay tax on all $660,000 because they can claim a Section 121 exclusion, and they enter the Section 121 exclusion as negative gain from the sale or loss on the sale. And so the ultimate profit that they'll have to pay tax on is $160,000, and that $160,000 profit will carry to line 13 of their Form 1040. Sale of stock. If you sold stocks, bonds, or commodities, you should receive Form 1099-B, proceeds from broker and barter exchange transactions. You are required to report all taxable sales of stocks, bonds, and commodities on Schedule D. Sale of stock is subject to some additional rules that do not apply to the sale of other property, and one of the more important rules concerns wash sales. Wash sale is a term you should understand, and you should understand when you have a wash sale. A wash sale occurs when you sell stock at a loss and then repurchase the same stock within 30 days prior to or after the sale. Under the rules for wash sales, you may not claim a loss on your sale. The loss on the sale of your old shares adds to your basis in your new shares. And here's an illustration. Your basis in XYZ stock is $1,000, and you sell XYZ stock for $750, and then within 30 days from the sale, you buy that same stock for $800. Your basis in ABC stock is $2,000. You sell ABC stock for $900, and then within 30 days, you purchase ABC stock for $800. So in both these examples, we have a loss, and then within 30 days, we purchase that stock again. So what do we need to do? Because you bought substantially identical stock, you are not allowed to deduct your XYZ loss of $250 or your ABC loss of $1,100. You must add the disallowed loss to the cost of the new stock to obtain the basis of your new stock. Your basis in the new stock is your disallowed loss added to the cost of the new stock. So here's XYZ stock. Bought for $1,000, sold for $750, then bought again for $800. Loss not allowed is $250, so $250 plus $800 gives us the new basis in the new stock, $1,050. On the ABC stock, we buy for $2,000, we sell for $900, then we buy again for $800. The loss not allowed is $1,100. We're going to add that to the repurchase cost of $800, giving us a new basis in the ABC stock of $1,900. And here is Form 1099-B. Unlike Form 1099-S, you will almost never see a 1099-B issued by a brokerage house that looks like this. Instead, you will typically see a substitute 1099-B, which describes the line amounts and gives you a line number, but essentially does not look like this document at all. Still, I'm going to show you the standardized format of this form as provided by IRS, and then it's your job to essentially translate the information from this form as you are looking at a substitute document that might be issued by a brokerage company. And let's begin with line 1A. Line 1A is the date of sale, and it shows the trade date of the transaction. Line 1B is the QSIP number. It may or may not be blank. Sometimes there is a number in this box, and if there is, this is the number under which you could research the stock on the Internet. And it is issued by the Committee on Uniform Security Identification Procedures. Box 2, stocks, bonds, etc. This shows the proceeds from transactions involving stocks, bonds, and other debt obligations. You should report this amount on Schedule D as the proceeds from the sale. Box 3, bartering. This shows the cash you received, the fair market value of any property or services you received, and or the fair market value of any trade credit credited to your account by a barter exchange. You should see Publication 525, Taxable and Non-Taxable Income, for more information on how to report this. Box 4. This shows backup withholding. It's the federal tax withheld box. Generally, a payer must back up withhold at a rate of 25% if you did not furnish your taxpayer identification number to the payer. You should refer to Form W-9, Request for Taxpayer Identification Number and Certification, for more information on backup withholding. And you would include any amount shown in Box 4, and you would report that on Form 1040 as tax withholding. Number 5, number of shares exchanged. This shows the number of shares of the corporation stock that you held and sold during the year in the exchange. So essentially, this is a pretty important number. If you bought 100 shares, but you only sold 50, it would be really important to spread or allocate basis from the original 100 shares you purchased and divide that by half so that you only claim half the basis when you sell. So keeping track of the number bought and the number sold is very important. Number 6, classes of stock exchanged. This shows the class or classes of the corporation stock that were exchanged. 7 is the description. It usually shows the name of the stock that was sold. Number 8 refers to regulated futures contract, the profit or loss realized from the sale in 2010. Box 9 is unrealized profit or loss on open contracts. Box 10 is unrealized profit or loss on open contracts. Box 11 is aggregate profit or loss. And usually, typically, when you have numbers from regulated futures contracts, you're going to have to report those sales on Form 6781. Finally, Box 12, if this box is checked, the recipient cannot take a loss on their tax return based on the amount shown in Box 2. Now, I've just finished showing you the layout of Form 1099-B, which has been around for a number of years, but beginning in tax year 2011, the IRS has a new 1099-B because there is a new law mandating basis reporting for publicly traded securities that takes effect in 2011. A Government Accountability Office study showed that 7 million taxpayers, more than one-third of those who sold securities, may have misreported gains and losses, and about half of them did so because they misreported their basis. The law, which begins to phase in on January 1, 2011, is aimed at reducing those problems and lessening the burden on investors. An expanded Form 1099-B will be introduced for calendar year 2011 sales, and the new 1099-B must be filed with the IRS and furnished to investors in early 2012. The 2011 Form 1099-B shows the following information which will be added to assist taxpayers with figuring gains or losses to be reported on Schedule D. The important new boxes I've highlighted in yellow. The first one shows cost or basis, Box 3. The second one shows wash loss disallowed. And the third box identifies whether there was a gain or loss that was short-term or long-term. And of course, this is all information that's very relevant to us as tax preparers. I should caution you ahead of time, just my years of experience tells me that just because this information is reported on the document does not mean it's going to be correct. I predict that there's going to be quite a period of time while the brokerage houses are figuring all of this out and being able to report it accurately. Now remember I told you that 1099-B form usually doesn't look like that when you get it from your client. That is, your client comes in and they have a 1099-B, but it doesn't look like that. And that's because most brokerage houses don't use that standardized format. Instead, they use a substitute format. When you sell stock, Form 1099-B is issued to report the sale. It is acceptable and usual for brokerage firms to issue a substitute 1099-B form similar to the one shown below. You should refer to IRS instructions for Form 1099-B when reviewing information reported on a substitute statement. So here we have a 1099-B, and I've essentially taken a look at a UBS transaction or a UBS 1099-B substitute. And this is typically what it looks like. It'll have IRS Box 2, stocks, bonds, etc., gross proceeds less commissions and option premiums. And it has an amount, $13,115. Well, this amount is the amount that would appear on the standardized format if it were used, which it never is. So you'd be looking for the amount shown in Box 2 right here. What is the amount? It would be a number, except the brokerage house doesn't issue a document that looks like that. Instead, it issues this substitute document with a number equivalent to the number that would show in this box. And that number, in this case, is $13,150. Then the number that would show for federal withholding in Box 4, well, that's 0. Then we have IRS Box 1A, 1B, 7, which is the description, price, the number of shares for 5, for withholding, and proceeds from the sale. And it usually will line these up, many sales one on top of the other. And here you can see the date that the stock was sold, the QSIP number, the description, the price at which the stock was sold, the number of shares sold, and the proceeds from the sale. And here again is Schedule D. You must file Schedule D anytime you receive Form 1099-B or Form 1099-S. Even if you do not receive a 1099, you must still file Schedule D if you sold investment property during the year or if you sold personal use property at a gain. You may also need to file Schedule D if you sold business assets during the year. And of course, here is Schedule D. I showed it to you right at the start of our session. It is divided on page 1 into 2 parts. Part 1 is used to report short-term capital gains and losses. And you can see it asks for a description of the property, the date acquired, the date sold, the sales price, the cost, and the gain or loss. It also asks you to total up all of the short-term sale amounts. Then on line 2, it asks you to enter totals, if any, from Schedule D1. That's a supplementary page when you have more than the number of sales shown here. And then it asks you to total up all of your short-term sales price amounts. Also, if you have short-term gain from a Form 6252 or a loss from Form 6252 or from Form 4684, 6781, and 8824. 8824 is like-kind exchange. 6781 is those futures contracts. 4684 is casualty losses or thefts. And 6252 is installment sales. Net gain or loss from partnerships, S corporations, trusts, or estates shown on Schedules K1. Line 6 is short-term capital loss carryover. Enter the amount, if any, from your prior year capital loss carryover worksheet. And finally, line 7, we total up our net capital gain or loss. In Part 2, we have pretty much all of the same information. The only difference between Part 1 and Part 2 is whether we sold property held long-term or short-term. And if it was held more than a year and then it is disposed of, it is considered to be long-term. And again, we have all of that same information. Enter the long-term amounts from the Schedule D1, which would be a listing of all of your sales transactions. IRS wants you to list them all. And if you have too many to fit on Schedule D, they want you to attach Schedule D1 listing each individual sale. You then total up all of the long-term sale amounts. On line 11, you enter your gain from Form 4797, Part 1, long-term gain, also from Form 2439, 6252, 4684, 6781, and 8824. 2439 is a specialized form. We won't cover that till a little bit later in our course. 6252 is, of course, installment sale. 4684 is casualty or theft loss. 6781 is that futures or commodities transactions, and 8824 is like-kind exchange. If you have any kind of long-term gain or loss that is flowing through to you from a partnership, S corporation, estate, or trust, then you would receive a Schedule K1, and the amount shown on that K1 carries to line 12. Capital gain distributions, these are the amounts shown on a 1099 DIV. And finally, line 14, long-term capital loss carry forward from an earlier year. And then on line 15, you total up all of your capital gains or losses. Page 2 of the form. Part 3 is used when there are some more complex calculations that need to go on because you sold specialized types of property, such as collectibles, or you recaptured depreciation. Now, if you are required to file Schedule D and you do not, the IRS will assess you tax on the gross proceeds from your sale without regard to any cost basis you may have. That's historically been the case. We might see a change now that they are showing cost on the 1099-B. Selling a business. The sale of a business is not usually a sale of just one asset. Instead, all of the assets of the business are sold. Generally, when this occurs, each asset is treated as being sold separately for determining treatment of gain or loss. A business usually has many assets, and when sold, these assets must be classified as capital assets. The sale of capital assets results in a capital gain or loss, or real property used in the business. The sale of real property or depreciable property used in the business and held longer than 1 year results in a Section 1231 transaction. And property held for sale to customers, such as inventory or stock in trade. The sale of inventory results in ordinary income or loss. You must figure the gain or loss on each asset separately. You must prepare and file Form 8594, Asset Acquisition Statement, when you sell or buy a business. Both the buyer and seller involved in the sale of business assets must report the allocation of the sales price among Section 197 intangibles and the other business assets. Both the buyer and the seller should attach Form 8594 to their federal income tax return for the year in which the sale occurred. Additionally, if you are selling your business or the assets used in your business, you may be required to file one or all of the following forms. Form 4797, Sale of Business Property. Form 8824, like-kind exchange of Section 1231 business property. Form 6252, installment sale income, and Schedule D, capital gains and losses. And here is a copy of IRS Form 8594, Asset Acquisition Statement, and we have filled this actually out for a sample sale of a business, and I'm going to show you the business assets that were sold in just a little bit. For now, we've allocated the business asset sales to appropriate classes, and looking at the form itself, you might be a little bit intimidated. What's Class 1? What's Class 2? What's Class 6 and 7? What do I do? And you'll also see that it shows general information, name of the other party involved in the transaction. So when you are involved in a transaction, you file the form, and you identify yourself as either the seller or the purchaser of the business. In this case, we have a seller. So who was the buyer? Well, Joe Buyer was the buyer, and what's his address? So we enter that. Then it asks for the date of the sale and the total sales price of the assets. So let's now look at the classes. In Part 2 of the form, you have to provide information about the assets, and you have to show the aggregate fair market value of the asset and the allocation of the sales price towards that asset. Class 1 assets are cash and general deposit accounts, including savings and checking accounts. Class 2 assets include U.S. government securities and publicly traded stock. Class 3 assets are assets that the taxpayer marks to market, at least annually, for federal income tax purposes. It also includes debt instruments, including accounts receivable. Class 4 assets are stock in trade of the taxpayer or other property of a kind that would be property included in the inventory as product held for sale. So let's just say that this sample sale included the purchase of inventory. Well, then that inventory would be reported as a Class 4 type asset. But we don't have inventory as a part of this sale, so the Class 4 line is blank. Class 5 assets are all assets that are not any other class of asset. And essentially, once you eliminate all the other classes of assets, you essentially have the fixed assets of the business. Things like an office building, photocopier, phone system, and computer. And we're going to show you illustrations of those calculations for how we arrived at this number on page 29 of this manual. Also, finally, we have Class 6 assets and Class 7 assets. Class 6 assets are all Section 197 intangibles as defined in Section 197, except for goodwill and going concern value. And Class 7 assets are goodwill and going concern value. And we show you an example of how to treat the sale of goodwill and going concern value, again on page 29 of this manual. Finally, down at the bottom it asks, did the purchaser and seller provide for the allocation of the sales price in the sales contract or in another written document signed by both parties? Very often it's been my experience that this is not the case. The buyer and the seller basically between them agree to sell a business for $100,000, but there's no allocation to the assets being sold in that sales agreement. So later on, we're actually having to make an allocation at a later point. So it is important to allocate sales price between what the assets that sold, and you'll see why when we get to filling out our sample 4797. And then finally, number 6, or line 6, in the purchase of the group of assets or stock, did the purchaser also purchase a license or a covenant not to compete? And in our illustration, no, that did not occur. So how do you go about reporting Section 1231 gains and losses? Section 1231 gains and losses are reported on Form 4797 in Parts 1 and 3. A net gain is carried to Schedule D, Form 1040, and reported as a long-term capital gain on Form 1040, line 13. A net loss is carried to Part 2 of Form 4797 and is claimed as ordinary loss on Form 1040, line 14. Form 4797, gains and losses from the sale of assets. Use Form 4797 to report the gain or loss from a sale, exchange, or involuntary conversion of property used in your trade or business or held for the production of rents or royalties. Form 4797 is comprised of 4 parts. Part 1 is used to report the sale or exchange or condemnation of Section 1231 property held more than 1 year, for which recapture or recovery of depreciation is not required. So here you see we have property held, and you enter a description of the property, the date acquired, the date sold, and you want to see that it was held more than 1 year. You enter the sales price any depreciation that was allowed or allowable since the acquisition, the cost of the property, and any gain or loss on the sale of that property. You'll also see that Part 1 provides space to enter amounts figured on other forms. For example, if you have an installment sale, you may need to complete Form 6252 first, and then carry the amount you calculated on 6252 over to line 4. You might also have a like-kind exchange, which required you to complete Form 8824, and if that's the case, you would fill that form out first, and then carry the total from that form over onto line 5. You might also have a gain, if any, from a casualty or theft loss, and that would be an amount entered on line 6. We also have line 7, where you add up the amounts shown on lines 2 through 6, and there are other lines to figure as well. Examples of asset sales or dispositions to be reported in Part 1 include the sale of office equipment used in a trade or business and held long-term. The depreciation is not being recaptured because the asset is disposed of for an amount equal to or less than its adjusted basis. The sale of real estate used in a trade or business and held long-term. Depreciation is not being recovered because the asset is disposed of for an amount equal to or less than its adjusted basis. And the sale of land. The sale of land held long-term should always be reported in Part 1 because land is not depreciable. Part 2 of Form 4797. You use Part 2 of Form 4797 to report ordinary income from the sale of business assets, not reported in Parts 1 or 3. Asset dispositions reported in Part 2 are generally assets which have been held short-term. However, Section 1244 losses are reported in Part 2 even if they are long-term. Examples of asset sales or dispositions to be reported in Part 2 include sale of office equipment used in a trade or business and held short-term, sale of real estate used in a trade or business and held short-term, and Section 1244 losses from the sale of small business stock. To be treated as a small business corporation, the total amount of money and other property received by the corporation for its stock as a contribution to capital and paid in surplus generally may not exceed $1 million. Up to $50,000 of loss or $100,000 of loss, if you are filing jointly, can be claimed on Form 4797, and any remaining loss is claimed on Schedule D and is subject to the $3,000 or $1,500 married filing separate limit. So if you are reporting Section 1244 property losses, you can claim those losses in Part 2 of Form 4797. You're allowed to claim up to $50,000 of loss or twice that amount if married filing joint, and is a special treatment for the sale of stock that normally would be subject to a $3,000 loss limit. Now, this rule of a $50,000 limit only applies to the sale of Section 1244 property. It would not apply to the sale of, say, office equipment or real estate that was sold at a loss. Form 4797, Part 3. Use Part 3 to calculate recapture and recovery of depreciation or amortization on assets used in a trade or business and held long-term. Gain on the disposition of an asset that is recapture of depreciation is taxed as ordinary income, and gain on a sale that is a result of increased value or appreciation is taxed as capital gain. Now, most of the time we won't really be filling out lines 26 or 27. Most of the time when we're dealing with sale of assets for a client, a tax client, we're going to be looking at making entries on line 19 through line 25. So line 19, we would enter a description of each of the types of property that we sold. We would enter the date acquired and the date sold. Then we would also enter the gross sales price on line 20. On line 21, we enter the cost or other basis. On line 22, we enter any depreciation that was previously allowed or allowable to arrive at our adjusted basis on line 23. We then figure our total gain on line 24. If we sold Section 1245 property, we enter the amount of depreciation that was allowed or allowable shown on line 22. And then we enter the smaller of line 24 or the amount shown on line 25A on line 25B. And we'll see how that works in an illustration in just a minute. Examples of asset sales or dispositions to be reported in Part 3 of Form 4797 include the sale of a car used in a trade or business where the sales price is greater than the adjusted basis and depreciation has previously been claimed for the vehicle. The sale of a franchise for a profit, where amortization has been claimed against the original purchase price. Sale of real estate for a profit, where depreciation has previously been claimed. Form 4797, Part 4. Use Part 4 to report recapture of depreciation on property for which Section 179 deduction has previously been claimed and the percentage business use has dropped to 50% or less, or for listed property where accelerated depreciation was previously claimed and the business use percentage has dropped to 50% or less. Income from Parts 1, 2, and 3 of Form 4797 is reported on Form 1040, line 13, if it is capital gain income, or on line 14 if it is ordinary income. However, recaptured income from Form 4797 is reported on the form where the deduction for depreciation was originally claimed. So let's just suppose in an earlier year you claimed a Section 179 deduction on an asset, and the business use of that asset has now fallen to 50% or less. Well, you originally claimed that deduction on Schedule C, so the recapture will be reported as income on Schedule C. It will not be reported as income on 1040 on line 14 or 13. Rather, it will be reported as business profit on line 12, and of course, if you're paying self-employment tax, it would be subject to self-employment tax. So here is an example of what we mean by how to do a recapture in Part 4. In 2009, Max purchased and placed a computer and service in his business at a cost of $2,000. He claimed a Section 179 deduction for the full purchase price on his 2009 Schedule C. Then in 2010, Max's business use of the computer drops from 100% to 40%. Calculate Max's recovery amount as follows. The depreciation he claimed in 2009 was $2,000. 2009 depreciation calculated straight line is $200, and the difference between the amount claimed and the straight line amount that he should have claimed is $1,800. Max must report the recapture of depreciation on Schedule C as other income. The recapture is subject to self-employment tax. Here we have Part 4 of Form 4797 completed. We show the Section 179 deduction claimed in the earlier year, the recomputed depreciation for the earlier year, and the net difference, the recapture amount. You should refer to the instructions of Form 4797 to see where to report this. And in our case, you'll report it on Schedule C as income. Now, I have been promising you a detailed illustration of how to complete Form 4797, and earlier when we were looking at the asset acquisition statement and the division of how we classified the assets being sold, we were referring to these assets. So you will see that if you total up these assets and then carry them back to that earlier illustration, the numbers in that illustration come from this schedule right here. During 2010, you sold the following business use assets, all of which you held long-term. Your net income from Schedule C was $38,609. Report your gains and losses from each sale as follows. We have an office building. It was acquired back in 2007, and you will see all of the assets were acquired on that same day. And we've got a sales date of June 15, 2010. All of the assets were sold on the same day. Here is the original purchase cost of these assets. And on the real estate or the office building, we also have $20,000 of land value. Accumulated depreciation claimed on the office building was $8,760, and this is the depreciation claimed on the computer, copier, and telephone system, and the amortization claimed against the goodwill. Thus, we have adjusted basis in each of the assets shown as follows. Office building, $111,240. $922 for the computer, $1,843 for the copier, $3748 for the telephone system, and $13,800 for goodwill. And this is the amount that each of those assets sold for: $150,000 on the office building, $500 on the computer, $2,000 on the copier, $7,000 on the telephone system, and $40,000 for the goodwill. So we essentially have a net gain. And how do we calculate that net gain? Well, we take the sales price and subtract out the adjusted basis. And you can see we have a net gain on the office building, a loss on the computer, a gain on the copier, a gain on the telephone system, and a gain on the goodwill. But we also have to take note of whether or not we had depreciation recapture, because depreciation is recaptured as ordinary income. And anytime we have a depreciation recapture, we know that we're going to need to report that sale or this part of the sale of that asset in Part 3 of Form 4797. So we have the office building where we have depreciation being recovered. That means that this sale needs to be reported in Part 3 of the form. We have a $157 gain, a $3,252 gain from depreciation, and a $4,200 gain from amortization recovery. All of these amounts need to be reported in Part 3 of Form 4797. But we have a loss on the sale of the computer, and so this loss will be reported in Part 1 of the form. And finally, we also have a sale of land, and that land too will need to be reported in Part 1 of the form. So we have a sales price here that is applicable to both the office building itself and the land, so we're going to need to prorate that. So how much of the sale are we going to allocate to land, and how much are we going to report to the sale of the office building? Let's go see what we did with that. It is, of course, very important to correctly allocate the above listed items into Form 4797 correctly. So I've just explained to you how to do it. Now let's go see how we do it. And Form 4797, like Form 45622, is a form where you should start on page 2 in Part 3. And we list each of the assets being sold. We have the office building, the copier, the telephone system, and the goodwill. We've listed the date acquired and the dates sold on each of those assets. Now on the office building, we sold it for $150,000 when we tie in the land, but we had to pull the land value out and allocate accordingly. And in this case, we've allocated $125,000 of the sales proceeds to the sale of the building. And on the cost of the building, remember we paid $120,000 for the building, but $20,000 was for the land. So we've pulled that $20,000 of land out, and that leaves $100,000 of cost basis being applied to the building. The amount of depreciation that was claimed on the building was $8,760, leaving us an adjusted basis in the building of $91,240 and a total gain on the sale of $33,760. Moving over to the copier. The gross sales price of the copier is $2,000. The original cost was $8,000, but we have depreciation that was previously claimed as $61.57. That leaves us an adjusted basis of $1,843. $1,843 from $2,000 leaves us a profit of $157. How much of the profit from the sale is depreciation? Well, $157 is profit from depreciation, so we enter that on line 25B. Gross sales price on the telephone system is $7,000. The original cost was $10,000, but we claimed $6,252 of depreciation, leaving us an adjusted basis of $37.48 and a profit of $32.52. How much of the profit from the sale is due to recaptured depreciation? Well, all of it. So we're going to carry that amount to line 25B. Then we move up to the last item that we're reporting in Part 3, and that is goodwill. The sales price allocated to goodwill is $40,000. The original cost was $18,000, but we claimed $4,200 of amortization, leaving us adjusted basis of $13,800 and a gain on the sale of the goodwill of $26,200. Well, how much of the gain on the sale is due to amortization recapture? In this case, $4,200. So some of the gain that we're reporting from line 24 is going to be subject to capital gain rates, and some of the gain reported on line 24 is going to be subject to higher rates of ordinary income. And the portion that will be taxable at the higher rate is the amount shown on line 25B. So down at the bottom of the form, we total up the amount of all gains shown on line 24 and carry that down to line 30. And how much of the gains shown on line 30 are recaptured depreciation or amortization amounts? Well, $7,609 is. So ultimately, that amount on line 31 will end up getting reported on Form 1040, line 14. Now, line 32, we have long-term amounts eligible for capital gain rates, but this amount is not carrying directly to line 13. We're going to have to do some additional computations on page 1 before we ultimately figure the amount that's going to be carrying to line 13. And here is page 1 of the form, and on page 1 we're reporting the sale of the computer as well as the sale of the land. the date acquired, the date sold. We show the sales proceeds from the sale of the computer. We show the sales proceeds from the land. We have the depreciation allowed, which was $3,078, and the cost or other basis $4,000. So we end up with actually a loss on the sale of the computer. But on the land, we originally purchased for $20, we sold for $25, and we have a $5,000 profit. So what do? Well, we pull over that $55,760 of gain showing on page 2 of Form 4797, and we then add or subtract the amount shown on line 2 to arrive at the total long-term profit from the sale of assets held long-term. The amount shown on line 7 is the amount that will carry to Form 1040 and be entered on line 13. Well, we're not completely done. Because the amount on line 13 is capital gain income, we're going to have to complete a capital gain worksheet to figure out how we benefit from the long-term capital rates and how much tax we're going to have to pay on the sale of those capital assets. Now, the Schedule D worksheet is a worksheet that we use to figure the tax we're going to have to report on our income for the year. There's multiple steps to this worksheet, and it's a rather intimidating worksheet. You really have to just spend some time reading it line by line and analyzing what it's doing. But it's actually a very logical form. You see this number on line 1? Where does the amount on line 1 come from? Well, I haven't shown you the full tax return. If we go back to this 1040 return here, we see I've given you income from line 12, 13, and 14. And if you add that up, you'll actually get a number higher than $94,478. But remember, this taxpayer gets to claim a deduction for half his self-employment tax. He also gets to claim a deduction for his standard deduction and his personal exemption, possibly other deductions as well. But we finally figure out what his taxable income is on the back side of Form 1040. And that taxable income is shown on line 43, and we carry that amount to the Schedule D worksheet and enter that on line 1. And the purpose of the Schedule D worksheet is to calculate what portion of capital gain income will be taxed as ordinary income and what portion will be taxed at the lower capital gain rates of 0, 15, or 25%. So let's just take a look at what's going on here. One of the numbers appearing on this form is $60,338. Where does that come from? Well, that is the amount shown on line 13 of Form 1040. It then asks, what is the amount shown on lines 18 and 19 of Schedule D? Well, that is the Section 1250 gain recapture or recovery. That is this amount right here from line 22 on the sale of the commercial building, $8,760 of depreciation recovery. So remember, depreciation has a maximum rate of 25%. So we enter that recovery of depreciation on the sale of the commercial building right here on line 11. We then subtract line 11, or the amount shown on line 11, from the amount of capital gains shown on line 13 of the Form 1040, and we get $51,578. And we then subtract the amount shown on line 13 from the amount shown on line 1 to get the amount shown on line 14. We then are asked to look to our filing status, and in this case we've provided you with a single filer, so the amount that we enter on line 15 is $34,000. Next we take a look at line 23. Line 23 shows the amount to be taxed at 15%. In this illustration, the tax on $51,578 of income is $7,737. So that's the amount of capital gain income for this filer that is going to get taxed at a rate of 15%. And the 15% tax on $51,578 is $7,737. Next, we pull over onto line 25 the amount of unrecaptured Section 1250 gain. That is from the depreciation recovery on the sale of the commercial building. And line 29 is then multiplied by 25%. So the tax on $8,760 is 25%, or $2,190. The next step on line 18 is to subtract line 10 from line 1. The difference between the amount shown on line 10 and the amount shown on line 1 is essentially the ordinary income of the taxpayer, and it's an important number to pull out. And essentially what happens on the next line is we take the base amount for our filing status, and if we can show that our total income for the year is less than this amount, then it's possible that some of our capital gains would be taxed at a 0% rate. But ultimately, when we're done with this problem, we take line 10 from line 1, and we're left with $34,140. This means that we're not eligible for the 0% rate on any of the capital gain income. It's all going to be exposed to a maximum rate of either 15% or 25% in the case of recovery on depreciation. So the next step on line 19, or the purpose of line 19, is to show the total amount of income that is ordinary income, and we will use the tax rate table in the back of Pub 17 to figure or calculate the amount of tax that is owed on $34,140. In this illustration, that amount of tax is $4,713, and that is actually entered on line 34 down here. So this entry right here, line 19, is used to figure the amount of tax that will ultimately get entered here on line 34. Line 23 of the form shows the amount of income that will be taxed at the 15% rate. In this illustration, the amount of tax calculated on 15% is $7,737. And then line 29 shows the amount of income to be taxed at 25%. In this illustration, that's $2,190. We then take up these three tax amounts, $7,737, $2,119, and $4,713, and total these amounts up on line 35. That gives us $14,640. The next step is to go back to the tax tables and look up the tax on the amount shown on line 1. If you go to the tax tables and look up how much tax you need to pay for a single person on $94,478, you get $20,162. And the final step is to compare line 35 to 36 and enter the smaller of those two numbers on line 37. Whatever amount you then enter on line 37 is the amount that you will enter on Form 1040, and you will carry this number, $14,640, to Form 1040 and enter it on line 44. The next password of the day, the password that you will use to open the Session 14 homework answer key, is Labrador, Labrador. And I'm sure you've heard of Labrador Retriever dogs. Well, Labrador is actually a region of Canada. It is the mainland portion of the province of Newfoundland. So if you have someone tell you they're from Labrador, it means they're from the province of Newfoundland, but they're not from the island, they're from the mainland, right tucked up next to Quebec. Reporting the sale of automobiles used in a trade or business. Did you claim the standard mileage allowance for business use of your vehicle? Because if you did, if you claimed business usage of your vehicle and you claimed the standard mileage allowance, then any subsequent disposition of your vehicle will result in the disposition of a business asset for which depreciation has been claimed. Remember, for 2010, depreciation is 23 cents for each business mile claimed under the standard mileage allowance. To figure the amount of depreciation you claimed over the years using the standard mileage rate, you must determine the number of miles driven for each year, and then for each year the standard mileage rate was claimed, multiply the number of business miles claimed by the standard mileage depreciation rate for that year. And here are the standard mileage depreciation rates by year. For 2010, the standard mileage rate is 50 cents per mile, and for each mile that you drove or drive for business, 23 cents is for depreciation. And you can see year by year there are adjustments. In 2009, the depreciation rate was 21%. It was the same in 2008. 2007 was 19 cents. 6 was 17 cents. 5 was also 17 cents. 2004 was 16 cents. And, of course, all the way back to 1994, where it was 12 cents per mile for depreciation back in 1994. So let's do an illustration here, or look at an illustration. So let's look here at an illustration of how we might figure depreciation on an automobile where we claimed the standard mileage allowance. In 2008, you purchased a car for use in your business for $20,000. You drove your car 10,000 business miles in 2008, 5,000 miles in 2009, and 7,000 business miles in 2010. During 2010, you sold your car for $10,000. Total mileage for the car is shown for each year in the following chart. The year is 2008, and the total miles driven is 15,000. The number of business miles was 10,000. So you're going to take 10,000, multiply that by the mileage rate for depreciation in 2008, which was 21 cents a mile, and that gives you depreciation claimed of $2,100. For 2009, total miles driven were 9,000, business miles 5,000, multiplied by the business rate for depreciation of 21 cents a mile, that gives us $1,050. And finally, for 2010, 11,000 total miles, 7,000 business miles, multiplied by the depreciation rate per mile of 23 cents. That gives us $1,610 of depreciation for 2010. So total miles driven were 35,000, total business miles 22,000, and the depreciation claimed was $4,760. So how do we report net gain or loss on the sale of the car? The total business use percentage is calculated by dividing the total business miles by the total miles driven. That is 22,000 business miles divided by 35,000 total miles is 62.86% business use on that car. The total business use basis of the car is calculated by multiplying the percentage business use by the purchase price. 20,000 times 62.86% gives us $12,572 to allocate towards the basis of the car for business purposes. The adjusted business use basis of the car is calculated by subtracting the accumulated depreciation from the business use basis. $12,572 minus $4,760 of depreciation claimed gives us adjusted basis in the business use portion of that car of $7,812. Now, 62.86% of the proceeds from the sale of the car are allocated as proceeds from the sale of a business use asset. So we're going to take that $10,000 of sales price, multiply that by 62.86% business use, and we get $6,286 to be allocated towards the business proceeds from the sale of that car. So we calculate the net gain or loss on the sale by subtracting the adjusted basis from the net proceeds of the sale. The net proceeds of the sale are $6,286. Subtract out the adjusted basis in the business portion of the vehicle, and we actually have a loss on the sale. So here's a little chart to help clarify what we just did. Cost basis is $20,000. Business use percentage is 62.86%. Business use basis is therefore $12,572. Accumulated depreciation is $4,760. Adjusted business use basis is $12,572 minus $4,760 for $7,812. The sales price is $10,000. Multiply that by the sales or business use percentage, and we get $6,286. And the net loss on the sale is $1,526. Of course, we would report the loss from the sale of the car on Form 4797 in Part 1 of the form. Well, there is no better way to figure out how to figure a form like 4797 or Schedule D than by practice and doing it. And the first classwork assignment of the day is to complete Schedule D and the Schedule D capital gain worksheet for the character Jake Edwards. Jake Edwards is married to Mary, who is age 34 and is a homemaker. The Edwards sold stock during the year and received a substitute Form 1099-B as shown next. They also sold some vacant land which was purchased on 1/1 of 97. The land has an adjusted basis of $20,000 and was sold on 10/3 of 2010 for $100,000. The Edwards have long-term capital loss carry forward from 2009 of $5,000. And the Edwards basis in their stock holdings was affected by the following splits. Kroger stock had a 2-for-1 split on 12/1 of 09. Nike stock had a 2-for-1 split on 8/9 of 10. And here is a substitute 1099-B brokerage statement from Smith Barney. We show net proceeds showing on the 1099-B of $9,820. And this is how those sales proceeds are broken up. We have the sale of the IBM, the Nike, and the Kroger stock, and the net proceeds less commission for each of those sales. We have the number of shares traded, the trade date, the broker fee held out, the trade price. And your job is to match those sales up against the following purchases. And these are the purchases that Jake had. Jake is an employee of Intel, and during the year he sold non-qualified stock options. The sale of the options was reported through UBS Financial Services. Jake's UBS Form 1099-B, his UBS Intel Advice of Exercise, and his W-2 are all attached. Please go ahead and prepare his Schedule D. Here is his W-2. And I just wanted to point out the information of relevance on this W-2. You can see that in Box 1 we're reporting wages of $128,621. Down in Box 12B we have a Code V, which you that there was a gross up in his pay included in Box 1 for the exercise of stock options, the amount shown in Box 12B will add to his basis in stock. So $3,621 is an amount you will need to add to his basis. Here is the advice of exercise that Jake Edwards received for the sale of his Intel stock, and you can see that it was a non-qualified option, the grant date, the exercise date, the number of shares sold, the grant price, the option exercise cost, the fair market value, the sales price, and the total gain. You'll observe this gain is the amount that was reported in his W-2 as income. So ultimately what you're going to see is that the sales proceeds and his cost are one and the same. So even though he buys at a discount, he's going to have a cost basis that's almost equal to the sales price. And here is yes. 1099-B reflecting the sale of that Intel stock option. Please organize Edwards' stock transactions, prepare his Form 1040 and the Schedule D shown here. Please push pause at this point. Complete the Schedule D and Form 1040 for Jake Edwards. When you are finished completing those forms, please resume video playback for a review of Jake Edwards' 1040 and Schedule D. So I have up in front of you now the answer key for classwork assignment number 1 for session 15. And of course this assignment involves preparation of Schedule D and Form 1040 for Mr. Jake Edwards. The starting point for this type of exercise is to organize the information contained in his tax situation. In this case, of course, it's a problem on a page, but if you had a real live client in front of you with a whole bunch of tax statements showing different types of capital gains, really one of the starting places could be to do an Excel spreadsheet to match everything up. Now sometimes brokerage houses do all of this for you ahead of time and makes it real easy. You don't have to do any further organization because the brokerage firm has already done that for you on some detailed sheets that they're giving you. And the brokerage firms are getting better at that. But let's just assume, or at least here in the case of Jake Edwards, they're not lined up, and so you have to do it. Well, when organizing data from numerous sales and purchases, it is extremely helpful to prepare a spreadsheet using Excel or some other similar software. Follow these procedures when preparing your spreadsheet. Begin by typing in all the buys and sells, and then compare your totals. If your totals match, use the sort function of the spreadsheet program to put all the stocks in alphabetical order. This will make it much easier to compare quantities and amounts. Eliminate any purchases that do not have corresponding sales. Calculate for differences in basis of stock due to any stock splits, and add in any brokerage or commission fees not included in basis. Figure the net gain or loss on each sale, and then move over and prepare Schedule D and compare numbers on the D to the numbers on your worksheet. And here's how we arrange things for Jake Edwards. We had sales of Kroger, IBM, and Nike, but in the wording of the problem we told you that Kroger had a 2-for-1 split. The worksheet shows the cost basis of Kroger stock that was sold during the year. The cost basis per share of Kroger stock sold is essentially cut in half. Remember to split the cost of the brokerage fee as well. So here is the trade price on the sale of the Kroger, the number of shares sold, and the broker fee at the time of sale. So this is the gross proceeds from the sale on the Kroger stock. But when we go over to cost, we've taken the Kroger stock and split it in half. So originally we bought 60, but there was a 2-for-1 split. So that reduced our cost basis in the original purchase by half and takes our cost per share down from $24 to only $12. We multiply that by the number of shares that we actually ended up selling, and that gives us a purchase price of $7.20, and of course then we add in 50% of the brokerage fee at the time of the buy. Now, the IBM stock was purchased in 2 separate transactions, but sold in a single transaction, so we divide the original cost of the IBM stock between the 2 sales as shown here. We actually sold 100 shares of IBM, but because we purchased it on 2 separate dates, we're treating it as 2 sales, just so that we can allocate the sale appropriately between the 2 dates. And it's important to do that because we have to watch for long-term versus short-term. And here we had a buy on 1/5 of 2010, and then we sell on 8/8 of 2010. So that portion of the buy is short-term. But this buy on 12/30 of 08 that was then sold is long-term. So it's very important to allocate these 2 sales correctly. And then we have the Nike. Nike also had a 2-for-1 split, and the worksheet shows the cost basis of Nike's shares that was sold during the year. So here's how we're calculating the cost in the Nike share. We have the purchase price of $35 a share. The shares traded $50. The price paid is $17.50, and the broker fee at that time was $20. We essentially have a cost basis in those shares of $17.70, and we're going to subtract that from the sales proceeds of $23.80, and that gives us a gain of $6.10. And on the IBM, we have a short-term loss of $2.10, and we have a long-term gain of $70. And on the Kroger, we have a long-term gain of $15.30. So let's take this information and put it on the Schedule D. Now, don't forget about the land sale that we described in the problem. The land sale is not included on the Excel spreadsheet, but we still need to report it in Part 2 of Schedule D. And there's also a long-term loss carryover from 2009 that we need to enter on Schedule D. And here is the Schedule D. We have IBM 50 shares that were sold. We enter the date acquired, the date sold, the sales proceeds, the cost or other basis, giving us a gain of $205. Nike 50 shares sold short term, and we have a date acquired, date sold, sales price, cost, and a gain of $610. We have the Intel stock as well. So the fair market value on the date of the purchase of Intel stock is ultimately the cost basis in the stock to Jake Edwards. And that is because even though he bought the stock at a discount, the difference between what he paid for it and what it was worth on the date of that exercise was bumped up into his wages, and he already paid tax on that. So he's not going to have to pay tax a second time when he sells. And in fact, when he sells, there's a brokerage fee that gets held out, so he doesn't even receive the full fair market value when he sells it. He receives $6 less and actually triggers a loss here. So we take $610, subtract out $205 and $6, and we get $399 of short-term gains. Then in Part 2 of the form, we're reporting the land sale. The land was originally acquired in 1997, sold in 2010, sales price of $100,000, cost of $20, and a gain of $80. We have long-term sales proceeds from the Kroger stock, originally acquired in 9, sold in 10, a sales price of $22.60, a cost of $730, and a gain of $1,530. We also have the IBM stock that was sold long-term, $25.90 of sales proceeds, cost of $25.20, and a gain or loss of $70. We enter the total long-term sales price amounts, and we enter the total short-term sales price amounts. And then we, on line 14, need to enter that long-term carryover from 2009 in the amount of $5,000. And finally, we take the amount shown on line 8, we subtract out the amount shown on line 14, and we have our net long-term capital gains to be reported of $76,600. On page 2, we enter the total of the long-term and short-term gain amounts, and they come to $76,919. We will carry that to Form 1040 and enter the total on line 13. And now we need to figure the amount of tax we're going to have to pay. So let's move over and figure the rest of the Edwards tax return. So Jake Edwards had a W-2 for $128,621, and he also has capital gain amounts to enter on line 13 of $76,999. We add up his income, and we have $205,620. We're giving Jake and Mary the standard deduction, so we subtract the standard deduction out of their adjusted gross income. We then subtract out their exemption deduction, that's 2 times $3,650. And on line 43, we have the taxable income, $186,920. So let's go see how we figure $31,000. And of course, to do that, we're going to need to complete a capital gain worksheet. And here we have the qualified dividends and capital gain rate tax worksheet. This is a shorter worksheet than the one I showed you earlier during the session in our student manual, because the student manual worksheet also provided space for figuring unrecaptured Section 1250 gain. This worksheet does not have as many lines because you cannot figure that kind of gain on it. And Jake did not have that kind of gain, so we simply don't need the bigger worksheet. We begin by entering the taxable income as shown on line 43 of his 1040 form. We then enter the amount of long-term gain shown on line 15 of his Schedule D. Next, we subtract out the long-term gains from the amount of taxable income that they have, and we have $110,000. Then we look for their line amount for their filing status. That's $68,000. Then on line 12, it asks us to enter the smaller of line 1 or 6, and in this case, line 6 is the smaller number. We carry line 6 to line 14, and on line 15, it says multiply line 14, that is the long-term capital gain rate amount, by 15%. So the tax owed by Jake Edwards on the long-term capital gains is 15% times $76,600, or $11,490. We then figure the amount of tax owed on the amount of income showing on line 7. Line 7 is the amount of income on which the Edwards must pay ordinary income tax. So essentially at this point we're going to go to the tax tables and look up how much tax the Edwards need to pay on $110,320. And we enter that total, which is $19,943 on line 16. Now we go to the tax tables and look up the tax on $186,920, and that is $40,581. We then take line 16 and we add that to the amount shown on line 15, and we get $31,433. The final stage is to take the lower of these two numbers, line 17 or line 18, and of course line 17 is the lesser number. The amount on line 19 carries over to the Form 1040, and of course that is the amount that we entered on line 44. There is no alternative minimum tax, there are no credits, so total tax for the Edwards is $31,433. The withholding shown on his W-2 was $32,155, and that leaves the Edwards with a refund of $722. That concludes the review of the Session 15 classwork answer key. Let's return to our student manual and take a look at classwork assignment number 2. For classwork number 2, you're going to need to just complete a Schedule D only, and this is for Sam Techman, who is employed by Chipmaker, Inc. During the year, he sold RSU and ESPP shares, and the following documents are attached: a copy of Sam's year-end pay stub showing RSU and ESPP awards and options that were added to his income. Also, a USB consolidated 1099 statement showing gross proceeds from the sale during the year. A USB advice of sale notice showing the cost basis in his RSUs, which he sold during the year, and 2 USB advice of sale notices for purchases of ESPP shares during the year. Use the information shown here to complete his Schedule D. And here is the UBS Financial Services Agreement. You can see that there are 3 separate sales. The quantity of shares sold was 1,847 total shares. The net proceeds from each sale, so his net proceeds total from the sale of those shares. And next we have his pay stub. Now you're going to have to spend some time analyzing this pay stub to look for the information that appears on the pay stub that could have an effect on his cost basis. You see we have some restricted stock units, that would be the RSUs. We also have this quick sale that tells you that there's some amounts that probably need to be figured into calculating cost basis. And this is probably going to seem a little bit overwhelming to you, but I really want you to spend some time analyzing these statements. Analyze these statements and think about them before you watch the playback of my review of the answer key. Here is more information from his year-end pay stub. This net statement is an advice of sale for the sale of the RSUs through Chipmaker, Inc. Please take some time to analyze that and do the best job you can of figuring what it means. Here we have the sale of Chipmaker ESPP, or Employee Stock Purchase Plan shares. And finally, the last advice of sale document I'm going to show. So at this point, please push pause. Spend a few minutes analyzing these tax documents for Jake Edwards. If you feel like you're floundering, that's okay. I'm going to go over a review of the answer key with you shortly, but you're going to do yourself a lot more good if you spend some time trying to figure it out before you watch the video review. So once you think you've done all you can figure it out and you've done the best job you can of preparing his Schedule D, resume video playback for a review of the Schedule D answer key. So at this point, please push pause. Do the best job you can, and when you are ready, resume video playback. I have in front of you now the Classwork 2 answer key for Session 15. Sam Techman received a Form 1099-B. He must therefore complete Schedule D. The 1099-B does not show cost or purchase date information, and to determine cost, it is necessary to review Sam's payroll records and stock sale notices. I should let you know that there is no standardized method used by employers to report exercise and sale of ESPPs, RSUs, or ISOs. We spent quite a bit of time talking about those income items. in Session 13 of our Basic Tax course, and you probably at this point may want to go back and review the manual for Session 13 just to refamiliarize yourself with how we calculate cost basis in ESPs, RSUs, and ISOs, and how that information applies to how I've calculated the basis in this particular classwork assignment. Now, the advice of sale documents provided in this classwork assignment are an accurate representation of actual tax documents I have received from my clients as a tax preparer. They were provided by a large Fortune 500 company, and I've put them in as exactly as I could so that you could see what it is I as a tax preparer look at and decipher when I'm figuring cost basis for the sale of ESPPs, ISOs, and RSUs. Now, since it is the concept of how to determine basis which is being examined here, please remember that any actual payroll and advice documents brought to you by tax clients will look different and may communicate relevant information in a different way. So let's begin with the USB statement. Sam Techman's Form 1099-B shows the sale of Chipmaker Inc. stock on 3 different dates. There are sales on 2/23 and 8/23 representing the sale of ESPP shares. The sale on 5/27 represents the sale of the RSUs. RSUs and ESPPs represent 2 different types of employee stock programs. With RSUs, the total fair market value of the stock is gifted to the employee and then grossed up in the employee's pay. With ESPPs, some of the fair market value of the stock is gifted to the employee, and the remaining cost of the stock is an expense to the employee. Only the gifted portion of the ESPP shares is added to the employee's pay. To determine the amount to enter on Schedule D as cost basis, refer to Sam's pay stub and advice of sale documents. Here is the advice of sale document for the RSU, and it shows the cost basis. His cost basis that was included in his wages as income is $23,875 multiplied by 145 shares, which totals $34.6188. You take this same formula, 254 times 23.79, all the way across and total those up. And when we do that, we get a total cost basis to Sam of $27,721.42. Each of these RSUs has been sold, and it's telling you here what his sales proceeds were. His sales proceeds that are shown on the 1099-B are $25,079, and his cost basis is $27,721, giving him a short-term loss of $2,642. So these RSUs actually dropped in value before he sold them. Here is how we determine the basis in the ESPPs. To calculate the cost basis of ESPP shares, add the purchase price of the shares to the gross-up amount included on the employee pay stub for the pay period in which the options are exercised. The purchase price on the date of the exercise is $16.495. The fair market value on that purchase date is $20.775. The difference between the purchase price and the fair market value is $428, and that amount is added to his income as payroll. He had to pay payroll, income tax, and Social Security tax on that amount, so we add it to his cost. Therefore, his true cost in those shares is $88.91.70. If he turns around and sells for $87.24, he'll ultimately have a loss of $168. So the sales proceeds shown on the Form 1099-B is $87.2391, and the sales proceeds shown on the advice of sale are $87.41.15. The difference is $17.12 and 12 cents respectively. This amount was withheld to pay the brokerage commission and transaction fees to USB Financial Services, and those brokerage commissions actually reduce his profit or increase his loss. The second advice of sale has the same type of formula going on. You look at the purchase price, you look at the fair market value, you look at the number of shares purchased, and the total sales proceeds. The difference between the fair market value and what that employee had to pay is grossed up into payroll as wages. Any amount grossed up into payroll as wages increases cost, so total cost to that employee is the actual amount paid plus the payroll gross up, and in this case that totals $48.94. Now we look at the amount of sales proceeds from the 1099-B. The 1099-B is for $4,811.62. The sale proceeds shown on the advice of sale are $48.2203. A difference of $10.39 plus another 9 cents was added to pay the brokerage commissions. Note that the cost of the shares, $48.94.26, is greater than the sales proceeds, and this happens when the fair market value of the shares drops between the time of purchase and the time of sale. Now, by examining the advice of sale document, we have determined the cost basis that should have been included in this employee's pay. The employer should report the difference between what the employee pays for shares and the fair market value of those shares as employee wages. And by examining Sam's pay stub, we are able to see that the required gross up to his wages has in fact happened. Let's take a look at this pay stub. We can see there's some restricted stock units. Well, that would be the RSUs. We also have the quick sale, and that totals $25.65.85. Let's look at the quick sale first. The ESPP wage gross up, the difference between the fair market value at purchase and the purchase price, is totaling $25.65.85. Is that correct? Well, go back to the 2 earlier pages and look at those advisive exercises and the amount that was included in payroll on them. And you can see that the amount that we figured that should have been included in payroll totals $25.65.85, and we see here that is exactly the amount that was in fact included in payroll. But this restricted stock unit of $43,089, that's a little more perplexing because it is more than the amount we see that he received as income from the sale of the RSUs. So RSUs with a fair market value of $43,089 have been awarded to Sam Techman during the year and were included in his pay. Sam's basis in his RSU shares is equal to the amount of income his employer added to his income at the time they were awarded. When RSUs are awarded, some shares are withheld by the employer to pay income tax. The value of all awarded shares is then included in his income. Then some shares are retained to pay taxes owed on the award, and Sam gets to keep any amounts that are remaining, or he can choose to sell them. So $43,089 of RSUs were added to Sam's income, but the sales proceeds that we are able to see on the earlier documents totaled $25,079. The difference between these numbers may be equal to the value of the RSUs that were withheld to pay tax, or that number could be entirely different. We simply don't have enough information to know. So the RSU shares Sam sold may include some of the shares awarded. He may have sold all of the shares awarded or only some of the shares awarded. The pay stub by itself does not contain enough information to know for sure. For this return, cost basis is determined based upon the advice of sale notice that Sam received and not actually from the pay stub. And here we have some more information that's interesting. This is the kind of the net paycheck that Sam received for the year. And money from the RSUs and ESPP shares was paid to Sam Techman directly by USB Financial Services and not through a paycheck. So income from the sales is reported on his W-2, but it's not included in his net paycheck that he received for the year. This is because the gross up for tax purpose has to be shown on his pay stub, but the check did not come from his employer. Instead, it came from USB. And here is capital gains and losses shown on the Schedule D. Each of these transactions is reported, the sales price for each, the cost basis of each, and the gain or loss from each. In this case, we had a loss on all three. Make note that we did total up the amount shown on the 1099-B. We don't ever want to have a number in Box 3 that is less than the amount showing on those 1099-Bs, unless, of course, the difference is here in Box 10. That can trigger an audit if there's differences. Here is the total loss for the year. On page 2, we're figuring the amount of loss to carry over to line 13 of Form 1040, and the amount that we will carry to line 13 of Form 1040 is $2,892. That concludes the review of Sam Techman's Classwork 2 answer key. The password to open the Session 15 Classwork answer keys is DRAFT, D-R-A-F-T. There are 2 answer keys because there are 2 classwork assignments, but both answer keys have the same password of DRAFT. And I'm going to leave you today with a homework assignment. This homework assignment I've been giving to my basic tax course students for a decade now, and I can tell you it is the most universally hated assignment. It is a difficult assignment. Even tax preparers who've been doing tax returns for a long time flounder in this particular assignment, but I really feel it does a good job of bringing together multiple forms that we discussed in today's lecture and earlier lectures of this course. You're going to need to prepare a Form 4797 for Diana Prince relating to the sale of a rental property that she owned. And because it is a rental property, there's just no way around actually having a Schedule E for the year, but I've made it as simple as I possibly can. So today, when you work on your homework assignment, you're going to be getting your first exposure to preparing Schedule E. And we're going to get more into Schedule E in a later session of our course. But for today, I'm going to make you do a little bit with it. And I'm giving you some items that you're going to use to calculate Diana Prince's basis in the rental property. You're going to need to figure any prior depreciation she claimed to arrive at adjusted basis. You're then going to complete the Form 4797. When you're done with that, you're going to carry the net gain or loss to Schedule D. You're going to have to prepare the Form 1040. You're then going to need to complete a 1250 gain worksheet and the Schedule D worksheet. So have fun with this assignment, and at the beginning of Session 16, we will, of course, review the answer key and show you how we've prepared a tax return for Diana Prince. Bye-bye.